Today we have Graham Rodder, who heads up the Hayes Knight AIC NT audit service line. He's an experienced registered company auditor with over 35 years of experience, including the audit of NT conveyances and land agents' trust accounts. Graham is also an experienced presenter of education programs for clients and others. His aim is to provide attendees with relevant and practical advice that will assist in running a better business. Nicholas Love is also with Graham today, and he's the Darwin manager. So please welcome our speakers. Thank you.
Thank you. I need Nick for his microphone. I'm Graham, this is Nick. Nick's going to talk to you about property and GST, and that might take a little while just to help you understand the sorts of things that conveyancers might need to understand about GST to the point where they just need to send it back to their client and say this doesn't seem to make sense. So a little bit of education there, and I'm going to talk to you about conveyancers' trust accounts and how they will be managed by taking you through an audit of a trust account in your mind, not necessarily the actual trust account, but take you through what we do. Okay, over to you, Nick.
Yep. Right, okay, so today we're just going to cover requirements for registering for GST. 4 different types of property we're likely to come across in our day-to-day transactions, and requirements for the margin scheme and going concern. As Graham mentioned just a moment ago, at the very least out of today, if we can just get some keywords or some phrases to look out for, that's going to be a trigger point for you to go back and ask further questions, okay, whether it's of your clients or their accountants or whoever it may be. Okay, so GST registration. We must register for GST if we're running a business or an enterprise. Now, that definition there is designed to be especially broad and can cover virtually any type of operation that you can think of, and that might be as simple as renting a property all the way up through big businesses or developing property or whatever it may be. So in addition to running a business or an enterprise, your GST turnover, if your GST turnover is $75,000 or more over a 12-month period, then you're required to register for GST. Now, just briefly, GST turnover, that's $75,000 over a 12-month period, excluding GST. And the way we would usually measure that is the 12 months leading up to the current month, or 12 months starting with the current month, so a projected GST turnover. If you're setting up a business and you're expecting that your turnover is going to be greater than $75,000 in a year, then you'll be required to register for GST. So our first type of property is residential property. Residential premises is property which is designed or built to be used as residential premises regardless of the intention or the actual use by the purchaser. So if the premise are intended to be occupied and capable of being occupied as a residential premises, or when the physical characteristics of the property are designed to be lived in as a residence. In the case of residential property, on the sale and purchase, but also on rent and expenses in running a residential rental property, for example, is what we would call input taxed, which is just another way of saying there's no GST. No GST on the purchase, no GST on the sale, no GST on income or expenses. Okay, just by way of clarification, there are some factors that are largely irrelevant when considering whether a property is residential or not. For example, the zoning of the property. If it's zoned in a commercial area, that doesn't automatically mean it's commercial property. Any non-residential use of the property. So if a property was, if you're running a business from there as a commercial enterprise, but it was originally designed and set up to be a residential premises, you've just turned a couple of rooms into offices or whatever it may be, that's still going to be a residential premises. If you've got any development applications approved or any non-residential rights attached to the property, such as a car park space in an apartment building. So just by way of example, If we've got a client, John, he's carrying on an enterprise and he leases a residential premises to a tenant living in the property. The area has been rezoned to commercial. John is approached by a big developer who says, I want to buy your property, I'm going to develop it. John says, great, going to get some really good money for this, sells his residential premises to the developer. That's still residential, despite the fact that it's commercial zoned and it's been bought by a developer who's going to develop it for commercial purposes. Another example, another client, Craig, he carries on an enterprise and is registered for GST, so he's in business as a sole trader, for example. He's got an apartment which he rents out, and attached to the apartment, or part of the apartment building, is a car park. Okay, if his tenant was to move out and he was to rent out the car park separately to the apartment after that, then potentially he's going to be having to deal with GST on the car park, but not on the apartment. Now, residential property is important to distinguish from new residential property. New residential property applies to property developers and taxpayers who buy and construct new residential property on land with a profit-making intention. So that profit-making intention, I guess, alludes to the fact that someone's going to be in business of buying and developing and selling, as opposed to an investor who's going to buy and hold. Okay, so a new residential premises would be a premises that has not previously been sold as a residential premises, or one that's been created through substantial renovations, which will affect the building as a whole, or when a new building replaces a demolished building. Okay, in the case of new residential property, GST is applicable on the purchase and sale of the property, and GST also applies to expenses incurred in building that property. Okay, if a residential premises, if a developer builds a new residential property and rents that out for 5 years, then it's out of the new residential property rules and just becomes standard residential property. Thirdly, we've got commercial residential property. This is property used in carrying on an enterprise of short-term residential rent. And that's things like hotels and motels, boarding houses, caravan parks, even potentially cruise ships or marina berths for boats or ships where they're used as a premises as well. Okay, the common characteristics that we see in commercial residential premises is that there's a commercial intention, so it comes across as a business as opposed to a passive type investment. There's multiple occupancies, it's being held out to the public or advertised to the public, centralised management, and the occupants are seen more as guests as opposed to residents. So in the case of commercial residential property, again, GST does apply to all the transactions relating to those properties. From a rental perspective or a tenanting perspective, there is a potential for concessionary GST treatment. So if you've got your short-term commercial residential premises, such as a hotel, but you've got long-term guests, so more than 28 days staying with you, the GST on the sale of the rent can potentially be reduced by 50%. The final type of property we come across is non-residential, and this is more our commercial sort of shops and factories and all the big buildings and so on. Okay, similar to the last couple of types of property, there is GST on property transactions in relation to non-residential properties, and we can claim the GST on purchases and need to remit GST on any rent relating to these properties as well. We often find, and I've noticed it especially up in Darwin, is that, say for example a shed out in Winnelly or something along those lines, people will have an area that you can live in attached to their shed. Upstairs they might have a bedroom and a little kitchenette and what have you up there. In most cases, if that's just, I guess, on the side, it's not a major part of the property, that's not going to affect the classification of that property as a commercial or as a non-residential property, even though you've got the ability for someone to be living there. If you've got an empty block of land, again, supply of land subject to GST only if the land is treated as trading stock in the business's activities. So in that case, you'd be looking at a large developer who's holding land, intending to develop it. Okay, that'd be their trading stock, as opposed to a passive investor. So in terms of the margin scheme, the margin scheme, under the margin scheme, GST payable on the sale of a property, is 1/11 of the margin on the sale, as opposed to the 1/11 of the full sale price. Margin is defined, there's two ways of defining the margin. We've got the consideration method, which is quite straightforward. It's the sale price less the purchase price. Otherwise, if the property was purchased prior to 1 July 2000, which is when GST was introduced in Australia, then we take a valuation of the property as at 1 July. So then we're only looking at the increase in the value of the property over that period of time, and then we're only dealing with GST on that margin as opposed to the full sale price. Broadly speaking, the margin scheme can be used if your client is registered for GST, the client is selling the property in the course of their business and GST applies to the sale. The property was first purchased using the margin scheme, and one of the most important points here is that there's a written agreement in place between the buyer and the seller prior to the settlement date. So that's a must-have, having that written agreement. Okay. One of the benefits that we find one of the benefits of the margin scheme, and I guess what it was designed for, is whoever's buying the property, if you or I were buying a property under the margin scheme and we just intended to live in it as our primary place of residence, we're not registered for GST. So if there was GST on the sale of the property, we could potentially be paying an extra 10%, $500,000 property plus GST, we'd have to pay $550 for it. Under the margin scheme, okay, you wouldn't have that full $50,000 worth of GST. It'd only be on the margin. So, for people like us, it'd be a good saving there, or whoever it is that's purchasing that property. Okay, the other set of rules we're going to look at today is going concern. Now, going concern, a supply of a going concern occurs when a business is sold with all the things that are necessary for that business to continue operating, and the business is carried on up until the day of the sale. So really, when we're talking about the going concern rules, we're talking about the sale and purchase of a business. Now, it is very possible to get properties through under the going concern rules. A property in some circumstances can be classified as a business in its own right. To get through on those rules, you'd expect that the premises is sold together with any assets and operating structure that are required for it to continue to operate in the way that it has been. Obviously, the building would need to be tenanted, and you'd expect to see a commercial lease in place as well. Okay. Now, if you are using the going concern rules, the implication there is that the vendor is not liable for GST on the sale of the property, and the purchaser subsequently is not able to claim any GST. But that's great. They don't have to remit it. We don't have to claim it. So it's still GST neutral. The benefit of that is that in property transactions, stamp duty is calculated on the GST inclusive price. So, if we had a nice commercial shed or something like that, a $2 million shed, and it was sold, and we didn't use the going concern rules, okay, you'd have $2 million plus 10% of GST, so you've got a $2.2 million property, and then you're calculating stamp duty on the 2.2. If you can get it through under the going concern rules, then the GST is basically wiped out. You've got a $2 million property, and stamp duty only on the $2 million. Okay, so there's an upfront saving right there. It also means that our clients don't have to fund the GST up front. Okay, so an additional cash flow benefit there. Okay, to be eligible for the going concern rules, the purchaser must be registered for GST. Again, the vendor and the purchaser must agree in writing that the sale of the enterprise is a going concern, and again that must be by the settlement date. The vendor must supply all things necessary for the continued operation of the enterprise, and they must carry on that enterprise right up until the date of sale. As far as farmland goes, sale of farmland is GST free if the land was used for a farming business for at least 5 years immediately before the sale, and the buyer then intends to continue to use it as a farm. The only other thing to note under the going concern rules is that there's a proposed change where the government wants to introduce a reverse charge sort of situation. And what that's going to mean is that the vendor is going to be responsible for both sides of the GST on a property sale or purchase. So they'll be responsible for remitting the purchaser's 10% worth of GST. On the flip side, they'll still be able to claim their 10% worth of GST. So it's a neutral effect, but then some people are worried that, you know, we're going to lose out on the stamp duty saving that we've had previously. Okay, so just in summary, when you're assessing GST on property-related transactions, the first step you need to look at is whether or not the vendor is registered for GST. If the vendor is not registered for GST, then you know GST is out of the question. That's it. There's you know not going to be any GST on that transaction. If the vendor is registered for GST, the second step is to correctly identify the property classification, so whether it's residential, new residential, you know, non-residential, or whatever it may be. Once you've determined that, then you can assess your eligibility for the margin scheme or the going concern rules. Okay, so that's everything that I had today. If anyone's got any questions, I'll take them before Graham comes up and entertains us all.
Just one question.
Yes.
So if it is a commercial property and the seller is going to be making more than $75,000 out of the deal and he's not registered, I thought it was whether he's registered or required to be registered.
Yeah, that's right. Look, if someone's, say for example, a property developer and they're buying and selling properties, or buying land and selling properties, okay, then you know their income is the sale of properties. So then you'd be assessing, well, are we over 75,000, which is very likely. If it was just you know a mum and dad business and they had a shed, you know, or what have you in Winnellie that happened to still be worth a couple of $1 million, and they sold that and it wasn't in their ordinary course of business, yeah. So yeah, distinguished there. But you know, I mean, but you know, if they're in business already, they're probably registered. So yeah.
Where there has to be an agreement in writing,
Yep.
does having a GST special condition in the contract constitute that agreement, or does that have to be something?
Look, I mean, it could come under your GST subheading, but it needs to be explicit. Like, you know, both parties agree that we are using the going concern, or both parties agree that we are, you know, using the margin scheme. Okay, and probably, you know, solicitors are probably the best people to speak to about the purchase and sale contracts. Yeah. Okay. All right. Thank you. I'll hand over to Graham now.